All right. Hello, everybody. Thank you for attending our webinar today on the One Big Beautiful Bill Act. Quite a few different things in the act that could be important for financial planning purposes and just for tax purposes in general. So, wanted to do a brief webinar on it. As with every time, if you have any questions, feel free to text us. That's our office number, but you can also text us on that number again, 980-444-0330. And as always, the video will be recorded, but everybody's already on mute, so you don't have to worry about us hearing anything that you're doing. Before we get started, let me just run through the disclosures with you. The important thing is reach out to an advisor, us, before making any decisions based on what we present here. I do want to put a little bit of a caveat on this one, that the bill is still relatively new. People are going through and parsing it and figuring out what it means. As with any bill, the Congress writes the bill and then they pass it, but then it becomes up to the regulatory bodies like the IRS to figure out what does it mean and put it into a regulation. So I mentioned that just to say that that there are some articles out there that were written prior to the bill being passed. I don't know if you follow this stuff like we do, but the House of Representatives wrote a version of the bill, had things in it, and then the Senate passed their version, and they brought it together through a consolidation process, and that's the bill that passed. So just as an example, that you may have heard of Trump accounts, we'll go over those in a little bit. Initially, the idea with them was to have money for children that when they became adults, they could have sort of a little bit of a nest egg to help them get started in life. But the final bill, it turns out that they're more like retirement accounts for children. You might see articles that talk about using them for college or for starting a business, things like that. But the rules are a little bit different than when those articles were written. So here's what we're going to be covering. The act made some tax changes from 2017 permanent. So if you remember back in 2017, they did the Tax Cuts and Jobs Act and changed quite a few things. And some of those were going to expire at the end of 2025. So if you've talked to me, I've told you, that things might change. The standard deduction might go back down to pre-2017 levels, adjusted for inflation. A lot of people don't itemize anymore. They would have started again, but this bill extended some of those things and made them permanent, revoked some tax changes made by previous administrations, added some new changes. I'd love to cover all 900 pages here, but I don't think you would like that. I probably wouldn't like that either. So we're going to hit the highlights and just like I said, recognize that it is a large bill and things could change as people go into it more and as regulators decide what Congress's intent was with what they passed. So what's been made permanent? The standard deduction increases that were done in 2017 were made permanent. You can see you have $15,750 for single filers, $31,500 for joint filers this year. Very similar to what it was last year, and again adjusted for inflation. Going forward, the mortgage interest is capped at $750,000 of indebtedness. Used to be that there was no cap, and then there was $1 million cap, and then now it's $750,000. That was part of the 2017 bill, and that has been extended. Current tax rates and brackets have been locked at their respective levels. So 10, 12, 22, 24, and so on. Income brackets are similar to previous years, and again, inflation adjusted. So, and finally, estate taxes, they set the number at $15 million for individuals, $30 million for married couples filing jointly, again, with annual adjustments. That's a little higher than it was last year, even if you adjust it for inflation. It's kind of like the new tax reset the number, and again, it will increase going forward for inflation. One thing to mention about the estate tax that is important to know is that the portability between spouses is not automatic. So an estate tax return has to be filed when the first spouse passes. You would think that if it's $15 million for each person and spouse number one passes away and everything goes to spouse number two, that when the second spouse dies, it'd just be $30 million of the communal assets that would get exempted. And that is true, but you have to put it in an estate tax return to allow the 15 million from the spouse who died first to transfer to the second spouse. Of course, we can help with that when the time comes, the unfortunate time comes. So notice we called this slide "What's Made Permanent," but everything is permanent in government and law until it's not. So, Congress can just change the law at any time, even though they're saying this stuff is permanent. 2 years from now, a new Congress comes in. I guess 3-4 years from now, a new president comes in and they say, hey, we don't like these tax cuts. We want to do this. We want to do that. We want to change this. We change that. And so this $15 million and $30 million for estate taxes, that's too high. Anybody who has over $1 million is rich. So we want to set the number to $1 million. That sounds like a pretty low number nowadays, but New Jersey's number at one point up until a few years ago, at this point, maybe 10 years ago, was $600,000 until they started taxing you. So there was one point a few years back where there was no estate tax at all. And very wealthy people that were sick were trying to decide, should I, it's kind of a bit morbid, but should I let myself pass away, or grandpa is on life support? Should we pull the plug on him before December 30th first to avoid estate taxes? So like I said, things can change. So you sort of plan for how it is, but recognize you might want to also plan for what might be. A lot of talk about the senior deductions. One of the promises made was no tax on Social Security. Well, and even after this bill passed, there are people framing this that way, but this is not the case. The seniors age 65 and older, they can claim a deduction of $6,000 as an individual, $12,000 married filing jointly. This extra exemption starts in this year, but it ends in 2028. There are some income limit issues. $5,000 for individuals, $150,000 for couples. It does start phasing out at that point, so it's not a cliff, but it will start phasing out at those numbers. A lot of our clients make more than that, and they were thinking, I'm going to get a lot of extra money from this deduction, and they end up not qualifying for it. So the other thing to point out is it's a deduction, not a credit. So it's not $6,000 or $12,000 in your pocket. What happens is it lowers your income by that amount, and then the tax is calculated off of that lowered income. So you really only get the benefit of whatever your tax rate is. And I have an example there on the slide where if the marginal tax rate is 22%, $6,000, 22% of that, the tax savings is $1,320. Still, it's not nothing, but it's not $6,000. It's $1,320. Unless Social Security is very low for somebody where maybe this extra deduction causes their tax to be down to zero on that bit, or maybe that extra added on for Social Security then gets lowered back down because of this amount, the taxable part of Social Security, then you could, I guess, claim that Social Security wasn't taxed for that person. But in general, it's a little bit different than what. So state and local tax deductions, one of the biggest complaints from 2017 in high tax states, which I know some of you are in, was that there was now a cap on state and local income taxes. So state and local taxes in general. So the cap was $10,000, and a lot of people in high tax states, that's more than they pay in income tax. Some people, fortunately, that in New Jersey, I know property taxes are horrible. They're over $10,000 just in property taxes, let alone income taxes and other taxes. One of the things they added to the bill was an income increase on that to $40,000 for single and married filing jointly. Married filing separately, $20,000. This number will go up by 1% every year. But again, there is a phase out. Now, this phase out's a lot higher than the senior deduction one, where it's around $500,000 of income before they phase out and go back down to the $10,000 number. Now, one thing to point out is this is, again, temporary, applies 2025 through 2029. And then at 2030, it reverts back to the $10,000 level. Again, nothing being permanent. They could, by 2030, decide to extend the higher number. They could, 2 years from now, say, we're going to put it back down to 10,000. It obviously depends on the whims of the politicians. So Next, we're going to talk about charitable contributions. I'm going to go ahead and hand it off to Max for the next segment.
And hello, everybody again. But for the charitable contributions, what we're going to be looking at is the difference between itemizing and not itemizing. So let me actually check one thing here. So if you are itemizing, it's a little bit more complicated. So I'll actually just touch if you're not itemizing piece first. If you are filing as single, it's $1,000 round number. If you're filing as a joint, it's $2,000 as a round number. Now it's permanently extended up to 60% of your adjusted gross income limit for cash gifts, which is obviously pretty good, but the difficult-ish part is really going to be if you are actually itemizing. So the rule is 0.5% of your AGI threshold is actually not going to be deductible, right? So as a simple example, if you're making $100,000, you multiply that by 0.5%. That just means the first $500 is not deductible, but everything else above that is. Why they made that so difficult, I'm not super sure, but just make sure that you guys are actually keeping your receipts. Next thing is going to be a little bit more spread out, right? It's the dependent credits are now increased up to $2,200, which is pretty good. The 529 plans, education plans, they're really going to be covering K through 12, which is really nice. They also cover homeschool, different credential programs and things like that, and post-secondary school, depending on what it actually is going to be. But the Trump accounts, this is going to be the big change. A lot of people have had questions about this. What it will be before the age of 18, all right, everything that I'm about to say is right before you turn 18. You get a single contribution of about $1,000, a seed deposit going into this account for anybody who is a newborn, and it's only a one-time seed deposit. But after that, you can have an annual contribution limit of about $5,000. Does not really matter who is able to contribute, right? It could be parents, relatives, employers, and others who can put money into this account up to $5,000 limit total. And that's per child per year. Now in 2028, that $5,000 will be indexed for inflation. So it will be able to grow a little bit over time, but that's not until 2028. Now, the next thing is going to be what happens at the age of 18, right? At 17, you can roll some of this money over into an ABLE account, depending on the faculties of the child, right? If they have some kind of disabilities and they are eligible for an ABLE account, you can touch it early by 1 year in that case. For everybody else, it's age 18. Now, at which point in time it rolls into a traditional IRA, and we can think about it up until that point that it still has those IRA rules, right? You can't touch it before 18, and anything that you do touch after that point is tax deferred. So it still grows tax deferred, it's invested tax deferred, but once you take that money out, you're paying your normal federal and state income tax levels on that money, just like a regular IRA at that point in time. And this one's going to be a little bit more, it feels like a little bit more all over the place. So I'm going to do my best just to make it as clear as I possibly can. I'm going to be moving a little bit quicker, but overall, what we're looking at here, let me actually pull this over, is going to be no tax on tips. So this is pretty big, especially for anybody who's working as like a busboy or waiters and things like that. You guys have up to $25,000 on the annual deduction on qualified tips. And that's from 2025 to 2028. Both employees and self-employed individuals get that exemption. All right. It does have a phase out period. I'm so sorry. It does have a phase out period on incomes, and we just have to make sure that we're talking about that, especially with Aaron, once we start filing out on some of those taxes. All right. Now, the next thing is going to be the Medicaid changes, right? The Medicaid changes, it sounded a little bad at first, but when we boil it all down, it's actually only to age 64. Going down to age 19, if you fall within that threshold and you are deemed to be able bodied, that just means you are required to work at least 80 hours a month, whether it's a part time job, community service, education, or work programs. You're required to hit that at least a month to be eligible to still have those benefits. If not, you will see changes on that Medicaid side. So it's not for everybody. If you don't fall in that bucket, you don't have to worry about it. If you do fall in that age range bucket, are you still hitting that 80 hours a month threshold? Clean energy, right? So we're swapping some of this out. And what this is really going to be doing is really for electric vehicles, EVs. The Big Beautiful Bill eliminated $7,500 of clean energy or clean vehicle credits for those EVs, and the $4,000 credit used for EVs. If you are going to have it, you can have that before September 20th, but that was 4 days ago. So I'm really, really sorry if you guys didn't get anything. But it did shift over from EV credits to interest deductions. So consumers who purchase new cars assembled in the US get up to a $10,000 deduction per year on the interest, or just for qualified loans, right? So if you go ahead and roll that over into a car that was assembled here, you still get a bit more of a deduction, and it does shift from that credit up to a deduction. So Aaron kind of explained that earlier. So just understand the differences. Reach out to us if you do have a question, especially about that one. But the next thing, right? The last two are going to be for the business owners. So you have increased support for businesses overall. Now, new business expenses and deductions, those provisions could actually boost what that growth might look like overall. So it helps with offsetting headwinds just with the different tariffs, RMDs, and what that is the expenses that you have are actually 100% deductible in that year that they are spent. So that is huge. And then the Big Beautiful Bill also has a effective January 1st, I believe it is, 2026. They are introducing a new overall tax benefit for itemized deductions for high income taxpayer. So those that are above the 37% tax bracket may or may not benefit you as much as you think. Right. So broadly speaking, the amount of money that you are trying to itemize to lower your deductions has a minimal impact as you progress above that line. So it's very, very technical. Not too many people are hitting that. If you are, we will talk to you guys about it on a one-on-one basis, especially once it comes time towards the end of the year, when we're doing taxes and making sure that we're preparing as to what this might look like going forward. Make sure that you talk with Aaron. Make sure that you're sitting down and having that conversation, because it can change our planning going. And actually, I'm going to hand it back over to Aaron on this one, just in case you guys are asking, okay, well, now I see what this all looks like. What am I going to say or do now that it is in place, and how does it impact us with investments going forward?
So thanks, Max. One of the most talked about parts of the bill was what happens to the deficit, what happens to the debt. There's sort of obviously two trains of thought on that. One is, if you cut taxes, then you will increase the deficit. I mean, it just makes sense. Less money in, the same amount going out. The other side of that is if less taxes can stimulate the economy because people have more money in their pocket. And in general, that can actually increase tax revenue just from the extra economic activity that comes from it. So the Congressional Budget Office estimated that the bill will add $3 trillion to the debt over 10 years. The current national debt, we know, stands at $36.2 trillion, at least when we made this slide. And so on the right, you can see sort of a waterfall graph of income and expenses from 2024 for the federal government. Just to change some of those dollar amounts into percentages, Social Security is 22% of the federal budget, Medicare 14%, and interest on the debt is 14%. So just those three expenses are 50% of the federal budget. So, and those are pretty difficult to adjust. I mean, you hear people say constantly, I don't touch my Social Security. I paid into that for 40 years, and I should get what I should get. Same thing with Medicare. People on Medicare tend to love it. Uh, and so those are, and of course, interest on the debt. If you don't pay interest on the debt, that's a problem. Already 50% of expenses are sort of off the table when it comes to trying to figure those out and maybe cut those. Although they've talked about having to cut Social Security at some point in the future, but you know how that goes when the time comes. Whether they will or how they'll do it is anybody's guess. Medicaid and CHIP. CHIP is a healthcare for younger, poorer people, children. 13% of the budget. Defense is 13%, and veterans benefits are 5%. And what they call income security, like low income social programs, SNAP benefits, food stamps, WIC, those kind of things are 10%. So those are also things people don't really want to cut. Making sure that the population is fed and making sure veterans get benefits that they were promised and things of that nature. Maybe you could defense spending could maybe get some cuts there, but those are going to be difficult. And then the remainder is education, transportation, natural resources like the national parks, and then what just falls under other. Those might be easier to adjust, but that's only 9% of the budget. And so we can see in the big red bar is right now what the budget deficit is. That's coming from borrowing. And so the concern is, this is a problem. When are we going to fix it? What's it going to look like when we fix it? What's going to happen to the economy when we try? What's going to happen to the stock market when we try? And the gut reaction is, this is scary. I don't want to be invested. I'm going to age myself a little bit and just say that as long as I've been alive, I was a child in the 1980s, a teenager in the 1990s, and people have been afraid of the national debt even back then. So I pulled this chart up, and it was very interesting to see that in the 1990s, the S&P 500 was at 379.41, and the national debt was right around $3 trillion. Fast forward, what is that, 35 years, and the national debt we saw is at 36 trillion, and you can see what the market's done. Right now, it's up around 6,000 or 6,500. I saw it on the screen, and I don't have it anymore. But we know, you can see from the blue line that the stock market is up substantially since the fears of the debt hitting $3 trillion back in the 1990s. And some of you, obviously, who are older than me, probably remembers when the debt hit $1 trillion, and it was just a mind-bogglingly large number, and something that was to be feared back then. And I can't argue with the concerns over a $36 trillion debt and having to try to figure out how to get the spending under control and what that might do. But making financial decisions based off of that fear would have been a terrible mistake. So that's why we recommend investing in a well-diversified portfolio, hoping to weather various economic conditions. And that's what's worked in the past, and that's what we think will work in the future to build long-term wealth. If you are not a client with us, and even if you are, of course, we're here to help you. And so I hope that you will reach out to the team with regard to any of your questions on that. We haven't had any questions come in today. And so we would just, again, like to thank you for taking the time out of your day to join us. I hope you found something that you can take home with you, something if you want to ask questions to me about or Max about, you can feel free to reach out to us. Otherwise, I hope you guys have a great rest of your day, and we'll talk soon. Thank you.